Financial Officer for startups in the Boston area, and Michael has asked me to speak with you today about the Financial Data Room and what that's all about in terms of your business planning efforts with Acela City. So what is a data room? It's basically when investors are serious about due diligence, they often ask entrepreneurs to give them a data room. It gives all of the company's secure and privileged information. The information can be stored in a secure shared space like Dropbox, Box, Basecamp, or similar service. And the required information scans many different categories. Product, market, customer, IP, legal, HR, and financial. So basic information in the data room would be on the product, market, and customer side, things like your pitch deck, general market industry studies and reports, list of customers, customer pipeline, historical revenue, and customer references. So all things about customers and product. The legal, IP, and HR side would include charter documents of your company, any of your board meeting minutes, stock agreements from previous rounds of investment, all your IP filings and org chart, and your material contracts and agreements. In the financial data room, you want to have your historical financial statements, list of key vendors and related agreements, your detailed cap table, 409A valuations, debt agreements, tax returns, list of capital expenditures, list of insurance, and most importantly, the financial model. And I'll address the rest of my comments in this presentation about your financial model. So a lot of times people ask me, why do a financial model? The numbers are meaningless. It's all going to change anyway. They all look the same. Investors are just going to basically ignore it and redo it. So what is the point? Well, here's a quick intro story. I don't know if any of you remember the Pet Rock back in the mid-70s, but it was a company that was started by an advertising executive named Gary Dahl, who passed away in 2012. He basically, before the holiday season in 1975, was hanging around with some of his friends who were complaining about their pets. And he's like, oh, well, you know, why not have a pet rock? It's easy to take care of. You don't have to take it for a walk. You don't have to feed it. It's always there for you. And they all thought he was crazy, but he basically put his marketing and advertising expertise to work and developed this pet rock phenomenon. And in 6 months, he sold 1.5 million pet rocks at $4 each. He earned 95 cents for each kit. So you can imagine, like, in 6 months, he was a millionaire. Unfortunately, he wasn't able to sustain his sales. He had raised a lot of professional investor money, and he wasn't able to deliver on his promises, so he got involved in a lot of investor lawsuits. He then opened an unsuccessful restaurant chain, and when he passed away, he didn't have any cash and is quoted as saying that he wished he had never started the Pet Rock Company. Now, this is kind of an extreme situation, but I feel that if he had some, thought process behind financial planning, business planning, and financial modeling, he may have been a little bit more successful than he actually was in the long term. So, quick agenda, quick few minutes on what financial statements are, discussion about designing a financial plan, developing your assumptions, and some conclusions. So really briefly, what are financial statements? Well, they're the key to your business plan. They demonstrate that your business plan is going to make money and puts numbers to your business model theory. It makes your business plan come alive for investors. All of those charts and graphs on market size and market penetration and IP, your entire deck, this all brings it all together for the investor for dollars and cents. And it really demonstrates that you know your milestones, you know your market, and you know how you're going to make money. There's three main financial statements: the income statement, balance sheet, and cash flow. The income statement is a result of the company's operations over a specific period of time. It measures revenue less expenses. The balance sheet's just a snapshot of your cash and asset position at a particular point in time. And the cash flow pulls the two statements together to show how you're generating cash from your income statement to your balance sheet. Here's some basic elements of financial statements. Your revenues are going to reflect cash coming in from products you're selling, services you're selling, any contracts you're selling. Your cost of goods sold or cost of revenue reflects the cost of those products or the cost of the service that you're going to be providing in terms of labor, and the cost of overhead for any contracts you might be selling. The operating expenses are things you need to pay for to operate your business: research and development, sales and marketing, and general administrative. And then a lot of times companies are capital intensive, and by that I mean they need to invest money in machinery and equipment or buildings in order to run their business. And all of these components are what drives the most important part of the financial statements, which is cash. So here's a brief profit and loss format, also called the income statement. It shows your revenue less your cost of revenue to get your gross margin. It's a very important metric for investors to look at. Less your operating expenses of R&D, sales and marketing, and G&A. This gives you your earnings before interest and taxes. If you have interest and taxes, you subtract those out to get net income. And then the key metric that investors look at are EBITDA or cash flow. So to net income, you add back interest, taxes, and depreciation. And the EBITDA or cash flow really tells investors how much cash your company is using or generating for the future. Cash flow statement, just a quick format, basically takes the net income or loss from your income statement we just looked at, adds back that earnings, taxes, and depreciation to get to EBITDA, looks at some changes in your balance sheet, where you're getting your money from in terms of investing activities and financing activities, and that gives you your ending cash. And then your balance sheet's just a simple assets equals liabilities plus equity. And this is what a balance sheet would look like. So what I'd really like to focus on now is designing a financial plan. So basically, as you think about what your financial model is going to look at, recommend that you think about focusing on your context. What business are you in? Are you a manufacturing business? Are you a software business? Are you going to do consulting and services? Where are you going to get your distribution from? How are you going to do your development of your product? In your industry, what are the traditional metrics for your industry, and are you in line with them? What's the sales cycle? Are you going to be able to just do a simple advertising campaign with Google AdWords and get customers? Or do you have to be designed into your customers' physical plant and inventory in order to sell your product? Are you going to sell your product directly with your own sales force, or do you need partners to sell your product? As I mentioned before, how capital intensive is your business? Can you outsource the manufacturing of something that you're making, or do you actually have to invest in production lines and warehousing space? And then why is your business going to do better or worse than the incumbents, and what kinds of investments do you have to make to maintain your competitive advantage? So I mentioned industry metrics. Here's a quick snapshot of 3 different companies: clean tech company, high tech company, and a SaaS company. And you can see that the cost of revenue is very different in each type of company, and the gross margin is very different in each type of company. So if you develop a financial model that isn't quite in line with your industry metrics in terms of gross margin, you need to be able to explain why you're doing better or worse than your industry average. When you take out the operating expenses, you get to that operating profit. And again, you see it's very different between the different companies. And again, this is another thing to look at as you present your financial statements in a backdrop to your industry metrics. Other metrics would be average revenue per employee and revenue per employee. So just some things that investors like to look at in terms of industry metrics as well. When you design your financial plan, you've probably spent a lot of time in your slide deck talking about your addressable market and how you're going to achieve market share. So for the pet rock business, for instance, the total market would be the gift market on a worldwide basis. The addressable market could be the gag gift market on a worldwide basis. And the served addressable market could be expensive gag gifts. In 1975, $4 is a lot of money to pay for a rock. You can buy it, one of those packages now on Amazon for $25. So that's still a lot of money to pay for a gag gift. So the served addressable market could be, higher end gag gifts. And then what percentage of that market would you achieve if you executed on your business plan? I think this is one of the most important slides for entrepreneurs to remember as they're thinking about their business plan and financial plan, is financing milestones. This is how investors gauge how much money they're going to give you and how they're going to tranche it or give it out to you. So in the very early stages, you typically might be raising money from friends, family, or angel investors for product development. And at the end of whatever amount of money you raise for that, you should be able to show an alpha or beta version of your product. You might have some pilots going or about to start. You might have some IP protection going with an IP lawyer, and you should have a team that would be fundable. Once you go for angel or early stage investment, your pilot should be underway. You have plans for a regional or national launch. Your team is getting bigger and you have more IP. In the growth stages, you're looking at Series A, B, or C venture capital, and this is really to promote the growth of the company. And then later stages, as the company matures, maybe you IPO or get sold to a larger company, and then or your company's not being very successful, perhaps being sold to another company. So these funding milestones are really, really important to think through as you put down your financial model. How much money do I need to get to each milestone so that I can raise more money to get to profitability? Some key elements in the financial plan: build a story. Try to do a detailed bottoms-up approach for at least the first year and possibly the second year of your financial model, and build on the story that you've put on in the slides in your deck. 5-year projections are things that investors like to see, although who knows what's going to happen tomorrow versus 5 years from now. But if you have a detailed discussion plan for the first 3 years, I think that's good. And then what years 4 and 5 could be. It's important to show a monthly perspective to cash flow break even, and call out your key assumptions and risks that you're putting into your financial model. This brings up sensitivity analysis, doing scenarios for your model in terms of best, most likely, and worst case scenarios, and be able to talk about the inputs and the thought processes behind those scenarios. And then selective market metrics, we kind of talked about that already. All with the focus coming down to sources and uses of cash, and how much cash do you need to get to the next fundable milestone. When you develop your assumptions, there's plenty of things to think about. How are we going to do that? So in your revenue is your units times price. So what's your sales unit? Are you selling an object? Are you selling a pet rock? Are you selling software as a service and you're therefore a subscription? Have you developed a technology that's licensable? So you're going to be selling, royalty licenses for that technology. How are you determining the price? Are you looking at what competitors are charging for what you're selling? Are you looking at pricing trends if there's, commodity pressure for what you're selling? Are you priced in line with your competitors? And what's going to happen in the future if your competitor is able to copy you and compete with you on price? Where can you, adjust your pricing and your business model to compete? The relationship of the numbers is important. We talked a little bit about the addressable market and your serviceable addressable market. So if your market is $1 billion and in year 5 you're at $1.2 billion in revenue, that's probably not realistic. So to keep in mind, what your market sizes are vis-a-vis what your revenues are going to look at. If you're on a recurring revenue model, maybe with a SaaS model, think about what your installed base is going to look like and how that's going to grow along with your revenues. Sales expense should relate to your revenue and be a percentage of that. In the hockey stick growth, where you're at $1 million, $1 million, $1 million, $50 million in year 3, probably isn't very realistic. And again, back to those key milestones, of which first customer ship date would be one of them. In terms of your cost of revenue, which is your units times the cost to produce, how much is it going to cost you to make that unit? So the pet rock people, they basically went to Mexico and took their rocks off a beach and brought them back and put them in the packaging. So the real cost of their pet rock was the packaging and the shipping and the labor to go to Mexico and pick the rocks up off the beach. So, what's going to be your comparable cost in your business? Look at your comparable businesses and your competitors to look at maybe how much are they need to charge, or how much are they paying for their raw material, or how much are they paying for their labor, and do some benchmark against some of their vendors to see how your assumptions hold up. Do you have fixed costs or variable costs? Fixed cost is a cost that you have to pay whether you sell 1 unit or 1,000 units or 1,000,000 units of your product or service. A variable cost is, as it says, vary with the amount of volume you do for sales. And think about your cost basis as you need to meet future pricing pressures. Where can you get economies of scale in your unit costs as time goes on? And don't forget other costs of sales, like things like freight or tech support, warranty, warehousing costs. As you develop your operating expense assumptions, these are some things to think about. Your salaries are going to be typically in the beginning your largest cost. Sometimes 70% or more of your total expense will be payroll. Don't forget to model in fringe benefits for health insurance and other benefits. Don't forget to model in increases in salary. Every year you need to do performance reviews and think about people's salary increases. How much do you have to pay for bonuses to retain people? How much do you have to pay for commissions on sales? And sometimes marketing people get commissions too. Do you need to have technical people on your payroll, and how hard is it going to be to find them? Sometimes getting a recruiter to help you find those people is necessary, and recruiters can charge anywhere from $5,000 to $15,000, even $25,000 to place a person, depending on how hard it is to find that technical skill. Rent and utilities. A lot of people are working from home now, but hopefully, we'll be back working together in offices again. And you might need to rent an office. So, benchmark what the office rates are and plan accordingly if you need to rent space. And don't forget utility expenses for electricity. Legal, very large expense for startups that have intellectual property. Basically, a provisional patent for one provisional patent in the US is $10,000 of legal fees on average. So think about how many patents you're going to need. And then once they go to utility patents, how much more you may have to pay to maintain that per year per patent. Operating expenses, as we mentioned, how are you going to sell your product? Are you going to do online advertising? Do you have to go to trade shows? Are you going to do other types of marketing? What's your website going to look like? Do you need to build a website that will do e-commerce? It's a lot more expensive than just building an informational website. Insurance is also something people sometimes overlook for product liability and general liability insurance. Think about your travel. Are you going to have to go travel to meet people to make your sales, or to work with vendors to get your materials for your products? What kind of outside contractors and outside help might you need for your business? And then things like repairs and maintenance and office expense. Cash flow, this is where you would reflect the capital expenditures or the things for furniture and fixtures or lab equipment that you might need to figure out here. You need to be able to speak about your cash burn or burn rate. You should know that on a monthly or quarterly basis for investors. And then the number of months of an operating loss before all your cash is gone. And then your cash flow break even. At what point will your revenues equal or exceed your expenses? Sensitivity metrics. I mentioned doing scenario analysis and the sensitivities. So you have to, expect and understand that these are guesstimates, not absolutes. But if you can talk about the sensitivities, I think that gives you a lot more credibility with investors. Talk about those leverage points, in terms of, are you an annuity sales model or a one-time sale? How hard is it going to be for customers to switch to your good or service? And once a customer has switched to you and they like it or don't like it, how hard is it for them to switch back to what they were using before? And thinking again about how you can get those margin improvements. The relationship of the numbers is really important. I think I mentioned that already. And then, again, key metrics, cash burn, cash flow break even, how long does it take to get there? How much does it cost to acquire a customer, cost of customer acquisition? What's the profitability of a customer once you have one? And what's the productivity of a salesperson? and that's that revenue per employee that we talked about as well. Some red flags for developing your assumptions. The financial model doesn't support your business plan assertions. I mentioned if your revenues are higher than your serviceable addressable market, that probably is a red flag that you haven't thought through your revenue assumptions very well. Time to profitability is unrealistic based on industry trends, and the gross margins and operating margins are not in sync with what your industry margins look like. Or you're providing metrics that aren't relevant, and the revenue and cost models lack some of those details about pricing and costs vis-a-vis the rest of your industry. And then your financing needs aren't linked to those all-important milestones. So how do I figure out how to get all this information? So Securities and Exchange Commission has a database, the EDGAR database, and you can go to publicly traded companies and look in their filings. 10K and 10Q reports have something called a management discussion and analysis section, where they talk about trends that are going on with their company and their industry. It can be very informative for you as a startup company to see what the larger companies are doing. I had a company I worked with once who was very excited to have a relationship with a publicly traded company in their area. They were all excited to do a joint development deal together, and then all of a sudden the company went silent, and the entrepreneur didn't really understand why. And so I suggested they look at the 10K of the publicly traded company, and in that management discussion and analysis, they had indicated they had left the business and left the industry, and that's why the entrepreneur hadn't heard from them. So you can get some good nuggets out of these publicly traded company financials. Yahoo Finance has a lot of information on companies. The trade press, there are specific publications focused on your industry. Read through them and search them for competitive information. And then market research reports. There are market research companies out there that will sell you just the graph that you need or the table that you need without having to buy a $10,000 research report. So some quick conclusions. Your presentations, part of your financial part of your presentation should be 2 to 3 slides max. The first slide being a summary profit and loss with relevant metrics. The second being a timeline with a capital raise mapped against your milestones. And then a third slide, if you wanted to, with a staffing plan. So you would definitely want to explain the top line. Here's a little bit of a blurb of what the financial table could look like. But indicate clearly what your assumptions are. Show the connections to your milestones and your market story. Know your break-even metrics and your burn rate, and be ready with that sensitivity analysis. So here's some graphics that you could use, with a table with some wording, or some graphs with total revenues and operating expenses. This is another profile that you could use that would map your funding against your manufacturing and business development initiatives and your technology development. From a 10,000-foot view, your financial slides really must be readable. Don't over-focus on valuation in the financial discussion. That'll is a topic for another seminar and webinar here. Really just focus on what you think the financial results are going to be. Be upfront with things you don't really know about. It's better to just say, look, I don't know, or I'm trying to figure that out. Can you help me, with that information, or do you know who I could talk to, rather than dig yourself into a hole making stuff up, because your investors do know your industry and probably know the answers to some of these questions. And again, align your cash burn to those milestones and try to raise at least 1 year's worth of cash burn in your first raise. And then, anticipate each round is going to take 6 to 12 months to close. So, plan for that in your financing strategy. So in terms of conclusions, and final thoughts, the financial section of the business plan is really the happy ending to your story. The investor mantra of show me the money, that's really where it comes down to all of your, all of your assumptions in your business plan and your slide deck comes down to, where the rubber hits the road here in the financials. And, reality gets funded. So that's pretty much it for this webinar. Again, my name is Suzanne Oakley. I'm a part-time CFO for technology companies here in the Boston area. And I look forward to the Q&A session that we'll be having later in July. Thanks very much. Bye-bye.